The rise of artificial intelligence has triggered a new wave of technological change and fueled a global investment boom. Stocks like Nvidia have become market superstars, tripling in price within just a year, and ETFs tied to related industries have also delivered impressive returns. In the last video, we discussed why energy will be the next true structural investment opportunity after semiconductors. If you haven't seen that one yet, I strongly recommend watching it first. Once you do, you'll understand why energy is the one investment theme you simply cannot miss over the next 10 to 20 years. Hi everyone, welcome back to my channel. In today's video, I'll walk you through where the real investment opportunities lie within the broader energy revolution and which ETFs are worth paying attention to. At the end of the video, I'll also share my own portfolio strategy and buying plan. So make sure you watch until the end. I hope this episode helps you turn the idea of investing in energy from a concept into a concrete, actionable plan. Let's start with the big question. Under the backdrop of the global energy revolution, where exactly are the investment opportunities? In the last video, we analyzed that over the next 3 to 5 years, the top priority of the global energy system will still be ensuring stable power supply to support the rapid growth of AI and data centers. In the short term, natural gas will remain the most reliable power source for AI infrastructure. But as a long-term value investor, I focus on more sustainable, medium to long-term opportunities. Natural gas can solve the problem in the short run, but essentially it is just a temporary solution. To truly break through the energy bottleneck created by the AI boom, upgrading and expanding the power grid is an inevitable trend. Over the next 5 to 10 years, the main focus of the energy industry will be the expansion and optimization of the entire system. Why is that? Because whether it's AI, data centers, electric vehicles, or the reshoring of manufacturing, all of these industries are driving explosive growth in global electricity demand. According to a 2024 report by Goldman Sachs, by 2030, U.S. data centers will account for around 8% of the country's total electricity demand, up from less than 3% in 2022. The same trend is happening globally. Electricity consumption growth is accelerating again, especially in developed countries, and between 2025 and 2030 this trend will become particularly pronounced. In other words, energy demand is rising sharply across the board, while supply is lagging far behind, especially in the power grid. Over the past decade, the United States has consistently underinvested in its grid. The pace of transmission and distribution construction has fallen well behind the growth of electricity demand. With a new wave of AI-driven demand, this gap is widening even faster. The current grid infrastructure not only fails to meet rising electricity consumption, it also struggles to handle the growing pressure from the supply side. Meanwhile, renewable energy capacity has expanded much faster than the grid itself, leading to situations in both Europe and the US where clean energy projects are completed but cannot be connected to the grid. This structural imbalance is forcing the energy system to rebalance itself, which means that future energy investment will focus more on grid upgrades, distributed energy storage, and flexible demand-side management. Only by enabling clean energy to be fully integrated into the grid and deliver stable power can we provide sustainable support for the growth of AI and manufacturing. Therefore, over the next decade, power grid infrastructure will undoubtedly be one of the core investment themes in the energy sector. Building, expanding, and modernizing the grid to connect renewables will require huge amounts of equipment, materials, engineering, and technical support. This means that the entire upstream supply chain, from grid equipment manufacturers, substation and storage system providers, to transmission engineering companies, will enter a long and sustained investment cycle. Broadly speaking, the investment opportunities can be divided into two main directions. The first is the supply side, meaning companies that participate directly in grid construction and provide the necessary equipment and technology. These firms benefit directly from infrastructure expansion, offering strong growth potential and high profit elasticity, making them the most explosive investment targets in the short to medium term. The second direction is the operating side, which includes companies responsible for power transmission, distribution, and maintenance once the infrastructure is built. These typically belong to the utilities sector, characterized by stable earnings, low volatility, and high dividend yields. While their growth potential may not match that of suppliers, their stable cash flows make them ideal for long-term value investors. At the ETF level, the two funds that best capture these two main investment themes are Grid and ZAP. Grid was launched in 2009 and currently manages over $4 billion with an expense ratio of 0.56%. Its goal is to track the Nasdaq Clean Edge Smart Grid Infrastructure Index, investing in companies around the world engaged in power grid equipment manufacturing, energy storage, power automation, energy software, and smart meters. Its top holdings include Schneider Electric, ABB, Eaton, and National Grid, companies that hold central positions in the global energy transition. Over the past 5 years, Grid has delivered an annualized compound return of 19.08%. It combines thematic growth potential with solid diversification, making it the most representative growth-oriented ETF within the smart grid investment theme. The other ETF is ZAP, which launched in 2024 with an expense ratio of 0.5%. It focuses on the themes of electrification and grid modernization in the United States, with most of its holdings concentrated in the utilities and industrial sectors. Its top holdings include Constellation Energy, Vistra, Quanta Services, Eaton, and NextEra Energy, leading companies covering power generation, transmission, distribution, and infrastructure services. Although it is still relatively new and smaller in scale, ZAP has already delivered nearly 30% returns this year, reflecting strong investor enthusiasm for the grid upgrade theme. These two ETFs could be viewed as a combination of attack and defense. Grid focuses on growth and serves as the attack allocation, while ZAP provides stable defensive returns. From a broader perspective, as long as AI continues to develop and data centers keep expanding, the entire energy system will have to evolve alongside it. The wave of grid investment is only just beginning, and it represents one of the clearest and most certain long-term themes in the energy sector today. Looking at the longer-term horizon, the biggest challenge facing the energy industry is still finding a safer and more sustainable source of electricity. Among all potential options, nuclear power is once again moving to the center of global energy strategies. Over the past decade, clean energy has made major progress, but challenges such as the intermittency of solar and wind, high storage costs, and low grid efficiency remain unresolved. This means that for the foreseeable future, relying solely on renewables will not be enough to support the stable baseload power required by the AI era. Nuclear power, on the other hand, is currently the only large-scale energy source capable of providing near-zero carbon emissions while maintaining stable and continuous electricity output. At the same time, a new generation of nuclear technologies is reshaping the entire industry landscape. Traditional nuclear plants take years to build, are expensive, and lack flexibility. But small modular reactor, SMR, technology is changing all of that. SMRs have shorter construction timelines, higher safety levels, and greater deployment flexibility. They can be built closer to load centers, which helps reduce pressure on the grid. This innovation allows nuclear power to shift from large, centralized plants to distributed, deployable energy systems, making it an ideal energy option for future AI data centers, industrial parks, and urban microgrids. From an investment standpoint, this trend is already being reflected in capital markets. The global nuclear industry is entering a new revaluation cycle. The United States, the United Kingdom, Japan, and France have all announced plans to expand their nuclear capacity. According to a 2024 report from the International Atomic Energy Agency, global nuclear generation capacity is expected to double by 2050. This means that over the next 10 to 20 years, nuclear power will become one of the most critical foundations of the global energy system, as well as the ultimate direction for the entire energy investment chain. For ordinary investors, there aren't many ways to gain direct exposure to the nuclear theme yet, but the most representative ETF is NLR. Launched in 2007 with an expense ratio of 0.56% and about $1.3 billion in assets under management, NLR tracks the MVIS Global Uranium and Nuclear Energy Index. Its holdings span nuclear power operators, equipment manufacturers, fuel suppliers, and uranium mining companies. Its top holdings include Constellation Energy, Duke Energy, Cameco, NextEra Energy, and Southern Company. In other words, NLR not only bets on the revival of nuclear energy, but also covers the entire supply chain, from upstream uranium mining to downstream power generation. It is one of the purest long-term nuclear energy ETFs available in the market today. By this point, we already know what to buy. In the medium term, the focus is on grid infrastructure, represented by grid and ZAP. In the long term, it is about the revival of nuclear energy, represented by NLR. Now let's move on to two more practical questions. How much to buy and how to buy? Let's start with how much, meaning position sizing. The energy transition is a long-term and relatively certain trend, but it is still a thematic investment. That means it will be influenced by many factors such as policy cycles, energy prices, and overall market sentiment. Therefore, I suggest keeping this entire sector under 20% of your total investment portfolio. Personally, my allocation is around 15%, which allows me to capture the opportunity while keeping risk under control. Here is how I divide it. NLR takes up 5% as a long-term position. Since it still faces some uncertainties and tends to be more volatile, I keep it relatively small. The remaining 10% goes into grid infrastructure ETFs, with 6% in grid and 4% in ZAP. Grid represents the supply-side growth theme, and it is more aggressive and growth-oriented, while ZAP leans defensive and focuses on utilities and grid operation, making it less volatile. Next, let's talk about the more practical question, how to buy. My overall approach is to build positions gradually. The reason is simple. All three ETFs are currently trading near historical highs, and short-term correction risk is elevated. Going in too heavily now could mean buying at the top. On top of that, trade tensions between China and the United States are adding to market volatility. So I will take a more cautious approach, starting with a base position and then scaling in step by step. Here is my accumulation plan. Take grid as an example. My total target position is around $8,400. Last week, I already bought about 25% at market price, roughly $2,000. That gives me some exposure, so I'm not sitting out completely. The remaining $6,394 will be divided into 3 limit orders based on price pullbacks. The first order will trigger if the price drops 5%, around $146.50. The second at a 10% drop, near $138.80. The third at a 15% drop, roughly $131. These levels may vary depending on volatility. For example, since ZAP is less volatile, I only set 2 buy levels with narrower ranges, while NLR, which is more volatile, has a wider buying range. Each time a price level is triggered, I will add to the position, roughly allocating 40%, 20%, and 10% of the remaining funds respectively. But what if prices do not fall and instead keep rising? I do not want to just sit and miss the move. That is why I have also set time-based triggers. After 10 trading days, and again after 20 trading days, I will buy small additional positions of about 15% each. For example, if grid stays high 2 weeks from now without hitting my price levels, I will add 1 small tranche based on time. If 2 more weeks pass and it is still holding strong, I will add another. This way, whether the market drops or rises, I can build my position steadily and systematically. Simply put, price triggers help me control cost, while time triggers ensure I do not miss the trend. Using this method, I can gradually build up to around 50% of my full position within 1 to 2 months, which is both steady and flexible. Of course, this step-by-step accumulation plan is not fixed. Its logic is based on my short-term market outlook. In other words, I currently believe the market is more likely to see a pullback soon. Under this view, a gradual approach helps me enter at lower average prices and spread out risk. But if the market moves differently from my expectations, I will adjust immediately. Specifically, once I believe short-term risk has eased, I will increase my exposure to 70 or 80% right away, keeping only a small cash buffer, about 20 to 30%, for potential pullbacks or new opportunities. As I mentioned in my earlier video on DCA strategies, in bull markets, lump sum investing often has a higher success rate. So the choice of strategy really depends on your market view. The ultimate goal is the same, to maximize returns while keeping risk under control. To sum up, the logic behind this round of energy investing is actually very simple. Rapidly growing demand exposes bottlenecks in the supply chain, and capital naturally flows to the technologies or industries that solve those bottlenecks. In the last cycle, the bottleneck was chips. When computing demand surged and chip supply could not keep up, the market's attention and capital flooded into semiconductors, giving rise to superstars like NVIDIA. Now, the new bottleneck has appeared: power supply for data centers. The expansion of AI has made the energy system the new constraint. Grid upgrades, energy storage, and nuclear power all aim to solve the same problem, ensuring that energy supply can support the next generation of computing demand. That is why the main theme for energy investing over the next 10 to 20 years will revolve around solving bottlenecks. The technologies that solve real problems will attract capital, and the industries that unlock supply will capture growth. Our job is to identify these key links early and position ourselves before the broader market catches on. If today's video gave you new insights, please remember to like, comment, and subscribe. I will see you in the next one.